Mr. Mitch Vicknair is our speaker today. Mitch Vicknair earned his MBA with an emphasis in accounting from Texas A&M and graduated summa cum laude with a BS in finance from the University of Houston. He had a very successful 20-year banking career, starting and managing several commercial lending departments for various banks, including Woodforest National Bank in the Woodlands, where he was executive vice president. In 2007, Mr. Vicknair was asked to be president of the Texas region for Reliance Bank, where he more than doubled his financial goal within the bank's first year of operations. In 2009, Mr. Vicknair left banking to become CEO of American Finasco. Over the last 26 years, American Finasco has helped thousands of companies avoid bankruptcy and return to profitability by restructuring and reducing debt obligations through their industry knowledge and negotiating expertise. Mr. Vicknair became active in private mortgage lending as an investor in 2008, and in 2010 began restructuring loans and finding funding sources for his clients, those that needed his service in that regard. He's also a parishioner at St. Anthony of Padua Catholic Church and began training to become a Catholic deacon in 2017. He's on the path toward ordination in January 2023. And let me just add that Mitch is also just an all-around really great guy. And we are so thrilled to have you here with us today. Would everyone please join me in welcoming to the podium Mr. Mitch Vicknair.
Thank you. Very good introduction. So we're going to talk about avoiding common mistakes with financial business. And the first thing I want you to understand is there's no quick fix. What we're really talking about is a long-term strategy for managing debt. If you've ever spoken to a personal financial planner about investing in the stock market, chances are they're not going to recommend that you try to outguess the market and get in and out a lot. It's, again, more of a long-term strategy that sets you up for your best chance of success. So, similarly, I want you to understand the steps you can take, not only today, but in the days to come, that will give your business the best chance for financial success from a debt management perspective. So feel free to stop me at any time if you have any questions. If I've said something that's unclear, you want to explore more, I'll be happy to answer your questions. Oh, by the way, I have to give my wife credit if you like the slideshow. I just had words on the screen. She's like, no, give me that. So all the cartoons are from her too. There are a few in there like this one. I don't know the answer to that question, so I'll try to answer your questions, but some I don't know. So a little bit about my background. Some of you may have had this experience at a bank. It's part of our commitment to small business. We'll lend you the bus fare home. When I started in banking, that was the experience I had at the bank I worked for. They did not really want to do small business lending, and it was very difficult to get anything done. So I left and started doing small business administration or SBA loans at a different institution. So if you're not familiar with SBA loans, whoops, skip too soon. If you're not familiar with SBA loans, it's a government guaranteed loan program where the bank loans money, government guaranteed 75%. It allows banks to do loans that take more risk than they would normally take. You still have to have a good business plan, have good credit. Generally, that government guarantee is a substitute for a lack of collateral. So a lot of businesses today, maybe buy a franchise, you're renting your space, you don't have any collateral, so banks don't want to lend money with no collateral, but they'll do an SBA loan. So I did that for 20 years. And as was mentioned, I was regional president for Reliance Bank, running there both conventional and SBA lending in Texas. And then in 2009, it was no longer fun to be a banker. And you may recall everyone was upset with bankers. And the bank stopped lending money. And so I went from being a lender to a collector, and that was no fun. I went from being, my client's best friend to someone they avoided phone calls. So I left there and I bought a company called American Finasco. American Finasco is a debt negotiator, and we represent businesses that can't afford to pay their bills. And we're like an alternative to bankruptcy, an alternative to high interest rate loans. We're trying to negotiate settlements so that our clients can stay in business. So as an example, someone owes $100,000 to a vendor that they're 6 months past due on, vendor sues them. They would hire us and we go in and, based on our averages, we would settle that for something like $5,000 a month for 12 months. So they end up paying $60,000 instead of $100,000 and can continue on in their business. So a few years into American Finasco, as was mentioned, we started private mortgage financing partners, commonly referred to as hard money real estate lenders. We're asset-based lenders. So the difference between us and a bank is a bank's primary focus is cash flow, and then secondarily, they look at collateral. For a hard money lender, we're primarily looking at the asset first, and then secondarily, we're looking at cash flow. So we'll do loans for people with bad credit. And again, all we do is commercial financing. So don't take anything I'm saying that's applied to residential. It's only commercial financing. We'll do loans to people with bad credit, with bad cash flow, with all kinds of problems, as long as we like the real estate. So we're usually doing 50% loan to value. So if we like the real estate, what we're doing is helping someone, give them a chance to survive. So a lot of our clients are being foreclosed on by banks who are going to be put out of business. We'll refinance the debt and give them a chance to survive, usually on a short-term interest-only loan while they're trying to get things straightened out. So I'll give you an example of one. There was a restaurant in Houston, and ironically, when I was in banking, I'd actually done the original loan. And so when he got into trouble, he called me and said, "Can you call someone at the bank and try to talk them out of foreclosing on me, because I'm going to lose my building, I'm going to lose everything." So I called the bank, and it turned out he had been in a problem for a while. They had been very patient with him, and there was no stopping the bank. They had finally reached the end of their rope. And so I went and met with him. Turned out that he owed about $1.4 million, and the buildings were $2.5 million. So plenty of equity in his property, but he didn't have any cash flow. He was the victim of being in a bad neighborhood, declining neighborhood, a lot of competition, forcing him to lower his costs or keep his prices low. And he didn't want to let quality suffer, so he could not generate enough cash flow to make a profit at all. And he was basically losing money on every client. We ended up buying the note at a discount, not requiring any payments from him, and giving him 12 months to sell his building. And about the 11th month, he was able to sell it for $2.5 million, pay us off. And then he had enough cash over to move to a different location and start up instead of losing everything. So that's what hard money lenders do. So through my experiences as a conventional banker, an SBA lender, debt negotiator, a hard money lender, I've seen a lot of businesses make tragic mistakes. And today I hope to share with you how to avoid some of those pitfalls in financing your business. First, you have to know the numbers. We're in good shape. Nobody understands our financial statement. Unfortunately, that's too true of too many small business owners. And, some of you cringe when I say that because you're thinking I'm not a numbers person, and that's fine as long as you consult someone who is. You have a trusted advisor that can help you understand the numbers if you don't. A lot of my clients in American Finasco, I like to say they run their business like a racetrack gambler. They keep making the same choices and losing money with the belief that if they keep working hard doing the same thing, eventually one of these races is going to pay off and solve all their problems. And that rarely happens. It's kind of like having a retirement plan of winning the lottery. It could happen, but it rarely does. So back to the restaurant example, my client from the earlier story, he was a great chef and his food was very popular, but he didn't understand the numbers. He had no idea that he was losing money on every client and that he was never going to retire. He thought if he worked harder and put more hours in and kept providing a quality product, that it would turn around. But he was in a situation beyond his control. It was not going to turn around. So he needed somebody to come in and explain that to him, and he needed a completely new plan of action. He had made further mistakes. So he stopped paying his sales taxes and payroll taxes, and he was using that money to pay the bank to try to avoid foreclosure. So by the time everything came crashing down, he was not going to just lose his property. He was likely going to go to jail because the government sees you as a steward of their money. Those sales taxes, especially the payroll taxes, is their money. It's not yours. And so if you keep that and use it for other purposes, that's the fastest way to go out of business and maybe even get yourself in jail. So the point of that story is sometimes the best decision is to shut down rather than going into further debt, right? And so if you don't understand the numbers, you'll never be able to make that decision. So be realistic. Obviously, I'm a proponent of paying all your debt. But I explained I own a company, American Finasco, who gets paid to help people avoid paying their debt. So let me give you an example of why we do that and when it's correct. So I have a landscaper as a client. Been in business 20 years, very successful. He thought it was his dream client. A large home builder in Texas hired him to put in all of the yards in their new builds. And so he, worked great for a while, and the home builder sales got slow, and so the home builder started telling him, well, I can't pay you to the house sales. And so then he's telling the nursery where he bought all the plants and the grass, I can't pay you to the house sales. And so he's stringing them along, and he's getting stringed along. Well, the home builder went bankrupt. And so then he's not going to get paid hundreds of thousands of dollars in receivables. And this had been his biggest client. Well, so then he didn't have any money to pay the nursery, but he was afraid to tell the nursery that. So he kept telling them, checks in the mail, I'm going to get it to you next month, and just trying to string them along until eventually the nursery got fed up and sued. He owed them over $100,000. And we got involved. When I called the nursery, the guy was irate. He's like, we were friends, we went hunting together. How can you lie to me like this? People, there's a lot of emotion there. So our first job was to get the emotion out of it. We told the vendor, the nursery, the truth about what was going on and explained why it happened. And, it was out of his control and he just didn't have money, he loved it paying, but he didn't have it. Well, long story short, we settled that debt for about 40 cents on the dollar and paid out over a 12-month period. And explained to the nursery, look, you can sue them, you can put them out of business, and you'll have a piece of paper you can hang on your wall, but you won't have any money because the bank's going to take everything, they have liens on everything. Or you can take 40 cents on the dollar, pay it out, and he'll keep buying things from you on a cash basis. So even though you're losing money, depending on what your margins are as a nursery, you're losing some money on what you've sold already, you'll be making money going forward. And they agreed with that. So ultimately the goal is to find a win-win solution where everybody comes out better than it would have been. Second example, client or a prospective client that we talked to that owed about $800,000, and I looked at his financials and it was a similar situation to the landscaper. And I said, look, based on my analysis, this is what you can afford. We need to sell this debt for about $400,000 at no interest, paid out over time. And and then there's some other things he needed to do to straighten out his business. And he refused. He said, look, I borrowed the money. I need to pay it back. I don't want anybody losing money on me. I said, that's very admirable. I agree with that wholeheartedly. But you can't afford it. And it's going to get worse, not better. So he didn't hire me. And then a year or so later, he called me back and said, okay, I'm ready to hire you. And so I go and look at the numbers. Well, instead of 800,000, he had 1.7 million. And his business has gotten worse. So he did not have, there was no realistic way that we could settle that debt. So I advised him to file bankruptcy, which is what he did, and he ended up losing his business. And he called me back, and you know, he realized, you know, I should have listened to you a year ago. I didn't want people to lose money, but had he listened to me, the creditors would have only lost 400,000. Now they lost 1.7 million. So that's what I mean, be realistic. We all want to make profit and pay our bills, and that's great. But if your business is not generating the cash flow it needs to manage the level of debt, you've got to be realistic and make some hard choices. And so I hope it's obvious that being realistic goes hand in hand with knowing the numbers. If you don't understand the numbers, you can't be realistic. You'll never understand what can happen. So advertisers have conditioned us to focus on monthly payment when we really should be focusing on total cost. And this is the number one thing I run into everywhere. People are conditioned to think that can they afford the monthly payment and almost ignore what the total cost is of a transaction. So I'll give you an example. I've got a borrower, and by the way, in all these examples, there's some big numbers going around. This is not all my money. I have lots of partners in all of these transactions. I believe in diversification. So don't get the wrong idea, but these are all deals that I'm involved with. So I have a borrower who owes us $220,000, and he's been paying 14% interest for 7 years. Interest only. It was a 1-year note that he keeps renewing. And I have tried multiple times to get him to refinance. I referred him to lenders, he never would call. So then I called lenders with his permission, gave him his phone number. I said, will you call this guy? He's a prime candidate for a commercial real estate loan. His building's worth $550,000, he only owes $220,000. And he should be able to get like a 5% loan. And they'll call him and send him paperwork and he won't fill it out. And I've talked to him a number of times, like, what's going on? He said, well, you know, I've got to rent it out for $4,700 and my monthly payment's only about $2,600, maybe $2,100 a month. Why do I care? So this is why he should care. On the left is the note that we have with him. He's paying, after 9 years, he would have paid us $277,000. If he had financed that at 5% over 9 years, he'd have paid slightly less, and his balance stayed at zero. The balance with us is still $220,000. So that's an example where the, keeping the monthly payment the same. In reality, since he was making $4,700 a month in rent, I would have recommended that he even finance it over a shorter period of time. So that's if he had financed it over 7 years. So this is actually today's scenario because he's been paying me for 7 years. He's paid me $215,000 and he still owes me $220,000. Had he financed it with a bank over 7 years, he would have spent a little more money, $261,000, but now he would owe zero instead of still owing $220,000. And the sad thing is his tenant was back. So now he's paying me $2,600 a month, and he's at risk of losing his business because he doesn't have a tenant. And he can't refinance now because no one's going to finance the building except for the hard money lender that doesn't have any cash flow. So don't get comfortable as long as you have debt outstanding. A lot of people treat their commercial debt as just like a second thought, a means to an end. And as long as the cash flow is there to service it, they just continue doing the same thing. And my recommendation is that you're constantly, I say constantly, a couple times a year at least, or annually at the bare minimum, take a look at all of your debt and if it can be structured better. If you can restructure it, get a lower interest rate, pay something off. This is what I've done through my career is constantly work to lower my rates and get the higher interest rate debt paid off. The final thing on the slide says apply for lines of credit that you don't need. So, most people only apply for a loan when they need money for a specific purpose. That is intuitive, but it's wrong. And that may sound like a contradiction. So I just said get out of debt, and now I'm saying apply for debt when you don't need it. So let me explain. I'll use myself as an example. I learned this lesson by almost losing the deal by not having liquidity. So I started applying for personal lines of credit anywhere I could, anyone that would give me a loan. And so I now have 5 lines of credit at 5 different institutions. They range from 2.99 to 4.5%. And all of them have 0 reporting requirements, and they don't charge me anything but I'll use the line. So they don't cost me anything to have these. So if you're fortunate enough to be in a strong financial position where you can apply and receive personal lines of credit, then I recommend you do it. They're infinitely more simple than commercial lines. In my case, they're cheaper. There's, like I said, no reporting requirements, and they've worked well for me. I'll give you some examples. So there's another school of thought here. Some people will tell you, do not mix personal and business. You don't want to take personal money or pledge personal assets for business purposes. My theory is that on all my business loans, I'm personally guaranteed it. If I'm personally liable anyway, I want to go for the lowest rate possible. So if I get a lower rate or an easier deal personally, then I'll do it personally, and then I'll just put the money in the business, because ultimately I'm responsible for paying it all back anyway if I'm personally guaranteed it. So that's my philosophy. Let me give you an example. I've got a friend who's we had this conversation. He disagreed with me. He would not do it personally. He had a business line of credit, and that was all great. Well, COVID hit, and his bank called his line because his business was declining, and they wouldn't finance it anymore. Well, they had to have the cash to run his business. If you don't know what factoring is, let me explain that real quick. Factoring is when someone owes you money. So let's say someone owes you $100,000. You sell that receivable to a factoring company. They will pay you some percentage of that today. So usually it's around 80%. So let's say they give you $80,000. Then once they collect $100,000, they're going to keep their fee and give you the balance. So let's say I sell a $100,000 receivable. I get $80,000 a day. In 30 days, they collect that receivable from the person who owed me. And so then they give me $18,000 and they keep $2,000. So that sounds pretty reasonable. I mean, they kept 2% and I got 98% of the money and I got $80,000 when I needed it, right? If you do that over and over again, it gets a little expensive. So on the left is an example of factoring $100,000 every month for 12 months. The factoring company is really only out $80,000. That's all they ever gave you. They gave you that to begin with, and then once they collected the 100, they just paid you 18 out of what they collected. So they didn't use their money to do that, right? And they got their 80 back too. So when they collected, right? So now they're into 0. So let's say you sell another 100. So this is a simple example of selling $100,000 every month for 12 months. You're getting $80,000 every month from them. But they never are out any more than $80,000. That's all they've ever given. If they charge 2% every time, you pay $24,000 over the course of a year, and they only gave you 80. You're paying 30% interest, not 2% interest. Okay, so this is what people don't understand, how factoring works, how these alternative forms of financing, it's always worse than it sounds. So I've got a HELOC at a bank, home equity line of credit, HELOC for short, at a bank. And this is the same guy that refused to do that because he didn't want to mix personal and business, right? So at the time, before his business went down, he would have easily qualified at the same bank I did for a HELOC. He could have borrowed $80,000 at 2.9% interest. And so instead of spending $24,000 over the course of the year, he would have spent $2,320. Okay? It cost him 90% more because he had to start factoring receivables, because then his business down, he didn't qualify for the HELOC, and his only choice was to factor receivables. So I'm a big fan of having lines of credit, and that's why I say apply when you don't need them, because that's the easiest time to get a loan. That's how bankers work, right? When you're desperate for money, it makes the banker nervous. He doesn't want to give you money if you're desperate. So I generally go in and, that's what I'll use it for. I say, I don't need it. I just want to have it available for investment purposes. And because if an opportunity comes up, and being in the business I'm in, lending money, I'm a real estate investor, opportunities come up. I want to have money available when something comes up. And so, it helps. These bankers nowadays all have goals, loan goals, deposit goals. And so 100% of the time I offer to open up an account and let them ACH, automatically debit the interest payment every month from my account. They love that. And I'll go to multiple banks at the same time. They're usually competing over my business to, so I can get the lowest rate possible. Many businesses, I gave you the example of my friend. Unfortunately, he survived. He turned things around, and now he has a new line of credit with a different bank, and he's no longer factoring, and so that's great. But many businesses failed during COVID. As I mentioned, I'm an owner or a partner in multiple businesses. One of them is a retail strip center that we happened to buy 2 weeks before the COVID shutdown. It's 2 buildings. One building is now 100% vacant. The other building lost its anchor primary tenant. So it does not generate enough cash flow to service the debt. When we bought the business, the building, we needed a quick close and we're getting a discount. So I used a hard money loan to buy it because I needed to close it very quickly. And I had a bank lined up to refinance it. Well, once COVID hit, the bank wouldn't refinance it, right? So I'm paying, because hard money loans are always at a higher rate. So I'm paying a higher rate, and the business can't afford to pay it. I keep saying I have partners in this as well. But we all had outside liquidity, lines of credit, and so forth. So we've never missed a payment. Every payment has been on time, and now we've got new tenants lined up. And within the next few months, we expect to refinance at the bank at a low rate. And they can look at our payment history. We've been paying, in our case, 8.5% interest, on time for 12 months, and so we can afford their payment at a lower rate. That's just one example of how having lines of credit help. I have another business that we bought in a turnaround situation, and it was losing money before COVID, and then COVID cost us 20% of our business. So then it was losing even more money. Again, me and my partners, we had outside resources with these lines of credit that we could use to keep that business going. We didn't have to lay anybody off. Everyone got paid. In fact, I'll talk about PPP loans in a second, but we're able to get a PPP loan for that business. And, not only did we keep all our employees, we gave all of our employees a 20% raise during COVID to make up for the money they were losing, because this is nurses that are paid per visit. And so they had fewer visits. So we paid them 20% more on the visits they had, so they weren't out any income. And that's what the PPP loan was supposed to be for. If your business was eligible, it was a government program. And those loans ended up being forgiven if you use them properly, which is what we did to not only keep staff, but give them a raise. So if I didn't have those lines of credit, I might have lost one or both of those businesses. And because the line is another advantage of doing it personally instead of the business. If I had business lines of credit, they would have been requiring financial statements on these businesses, and they would have seen me losing tenants, they would have seen the negative cash flow of the business, and they would have canceled my line of credit. But because they're personal lines, they don't ask for that information. And another key to lines of credit is banks like to see that you're using them properly. The way to use a line of credit is to go up on it and go down on it, right? If you have $200,000 outstanding on a line of credit for a year, the bank's going to look at it as time of renewal and say, well, we're going to turn that out. You need to start making payments on that. So what I do is move money from one line of credit to another. I have 5 different institutions. If I owe this bank $100,000 on a line of credit for a while, like they want to see that paid off, so I'll advance $100 on another line paid off. They don't know where I'm getting money, right? They just want to see that I'm paying it down. So when it comes to renewal, they look at it and look at district. We have this, you pay it down here, then 0. So if he's using it properly, we'll just renew it for another. And they just keep renewing them over and over again, and it puts me in control of managing my business instead of the bank. Also, I mentioned ACH, I make every payment on time. I use the line the way they want it to be used. So they have no reason to question what I'm doing, and they love me as a client. So the number one complaint I heard from my clients during COVID, well, number one was shutdowns keeping their customers away. But after that was a lack of access to capital. So while COVID impacted me greatly, I never suffered from lack of capital because of these lines of credit that I had previously set up before COVID. I went from using 10% utilization to about 80% utilization. I had to use a lot of those lines to keep my businesses going. But thanks to the PPP loans and now my customers are back, my business is back, everything's going well. I've been able to pay that debt down, and it really saved me during something no one could have foreseen. We were turned down for a loan, but our cap was pre-approved for another credit card. That's another thing I hear from a lot of people is like, I had a meeting yesterday with a guy that, I won't go into details. If I was a banker, I would finance him, but he could not find anybody to do his deal because it was a startup, even though he's got great credit and had a down payment and so forth. And he didn't want to, it's a good candidate for SBA loan. But in any case, it does seem crazy sometimes the way that decisions are made and who's able to get loans and who's not. But this just reiterates what I was saying, that the hardest time to get money is when you really need it. So when you're doing well, take advantage of that by applying for lines of credit and which your goal is to increase your liquidity and build a safety net. Character and relationships matter. So, as a banker, on more than one occasion, it's amazing to me still, I'd have people come in bragging to me about how they cheated on their taxes and, how they manipulated other bankers or hassled them into giving them a discount to, by making their jobs difficult. And I don't want to be in business with somebody I can't trust. And so I would never lend money to any of those folks. And by the way, I'm a big fan of tax avoidance. I do everything I can to avoid paying taxes, but not of tax evasion. Does anybody know the difference between tax avoidance and tax evasion? About 5 years. I mentioned I left banking in 2009 because my bank stopped lending and I bought American Finasco. It was difficult. If you remember 2009, banks weren't lending. It was hard to get financing. And I was buying a business that had no assets, had a history, a successful track record of cash flow. So I went and applied for an SBA loan. And fortunately, someone that I used to work with when I was in banking was now running the SBA department at someone else. I'm sorry, a different lender. So I had no experience with that particular bank, but I did with the person running the department. And she had a hard time getting me approved. I was like the only one she got approved for months. But because she trusted me and I had a track record of success, she put the effort into getting me approved and getting that loan. When if it was someone that she didn't know, I doubt she would have even tried. So, you know, we live in an online society where everyone is shopping for the best deal all the time. And, you know, I'll talk about shopping for low interest rates on my lines of credit. So I'm certainly not discouraging that or pointing any fingers. But it's caused many lenders, particularly your large national lenders, to convert their small business lending into, you know, a real cost-cutting model so they can make a profit. If they have to keep lowering the interest rates they're charging, they have to figure out a way to lower costs so that there's still a margin for them, right? And so this is great if you fit in the box. So, and I'm going to pick on Chase Bank right now. So if you fit in the box that Chase Bank has carved out for small business lending, then they'll be a great bank for you. But as soon as you don't fit in that box, they will not care about you. You will be gone, and they will make your life miserable until you're gone. So because of that, I'm a big fan of community banks. I bank at Guarantee Bank here in Conroe, and I've got a 20-year relationship with the president, and you know, they don't have the cheapest rates in town. I get calls all the time from other lenders wanting me to move and tell me they can lower my rates, and on paper it sounds good, but when if I need something, they're not going to be there, right? And I'll give you a perfect example. So when the PPP loans from the government came out during COVID to help small businesses, Guarantee Bank was all over it for me. They kept me very well informed of what I needed to do. If I made a mistake, I had 3 businesses that qualified. So on 1 or 2 of them, I made a mistake, and instead of just throwing it out and throwing me back into the line, they called me and said, hey, if you get this to me in the next hour or 2, you won't lose your place, right? And I'm part of an organization called Entrepreneurs Organization, which, by the way, I recommend you look into. It's for business owners that generate $1 million or more in revenue a year. And we act as each other's advisory board. When things like COVID happen, we have online chat groups where we share secrets and, you know, how are you doing this? How are you doing that? What's the best way to get this done? We share that with each other. Some of these folks were in a nightmare situation trying to get their PPP loans. I ended up getting funded on 3 loans before the majority of people I know got even one. And it was all because of my relationship with Guarantee Bank, because I've treated them with respect, and I try to be a good customer by, you know, they don't ever have to look for me. I answer their calls, I return their calls immediately. Any kind of reporting I have on loans with them, I get them in the day that they're due. They often tell me, you know, that I'm their favorite customer, and that's what I want to be, is the bank's favorite customer. Because, you know, like I said, I might have saved a little interest if I moved to a different bank, you know, to save 0.5% on a real estate loan that I have or something. But then that other bank wouldn't have been there for me when I needed a PPP loan. So let me give you an example of the other side. So I've got a friend who constantly moves banks. And he's got $1 million line of credit with his business, and every year when it comes to renewal, he shops it around and he beats them down for a lower rate, and then he'll move it if he needs to get a lower rate. Well, he had recently moved it when COVID hit, and guess what? They canceled his line. They didn't know him. He didn't have any relationship with him. And then he had to find alternative sources of financing like factories that were more expensive. And then he was very frustrated trying to get a PPP loan. And, the bottom line is, if you treat your bank like a commodity, they're going to treat you like one. And again, I've got these ancillary lenders that I do treat like a commodity. I'm trying to get the lowest rate I can on these personal, but I've got that one relationship that I treat differently than I treat the others, because I don't want them to treat me like a commodity if COVID comes around again or something else happens and I need them. Let's talk a little bit about alternative financing. I've already mentioned factoring. Merchant cash advance. That's similar to factoring, but it's selling credit card receivables. So what these companies will do is look at, if you have a history of charging and collecting $20,000 a month in credit card sales, then they will, I'm not sure how, they all calculate things differently, but they'll say, well, he can afford to pay us $10,000 a month out of that, so let's loan him $100,000. And so they give you $100,000, and then they take assignment of your credit card receipts, and it'll go into their account and not yours. And usually on a daily basis, there's a certain payment that's required. And so it sounds really small when you talk about, every day. But, $1,000 a day, which sounds like, if you're running like a big business, $1,000 in selling, well, that's $365,000, paying it every day. So I do not recommend merchant cash advance. Factoring, there are uses for, which I'll talk about in a second. Unless you can find a merchant cash advance that's at a reasonable rate, most of them are in the 30 to 50% range. And if you've got a fast-growing, high-margin business, then things like merchant cash advance and factoring can work for a short time, because banks are not apt to keep increasing your line. And these are things that you can increase quickly. If you're selling, receivables to factoring companies, so 100,000 this month, 200,000 next month, 300,000, they'll keep growing with you, right? And it's less hassle. But ultimately, the goal is to get out of factoring. And when I was a banker, I loved taking factors out, because I knew that client was paying, as an example, for somewhere in 20 to 30% in interest, and they could easily afford my 5 or 6% interest. So the goal is to ultimately get out of that. Hard money, I mentioned, that's what my other company does. It's usually real estate loans. You have to have equity in real estate to qualify for a hard money loan. Usually the rate's around 12%, roughly double what you could get at a bank. But again, if you find yourself in a situation like the restaurant I told you about, where he was going to lose everything, this is a way to save your business, save your real estate, and get a fresh start. Leasing, and there's other forms. I just put that out there to say there's other forms of financing other than going to a bank, stretching out your vendors. There's things you can do, but typically, if you get to find yourself in a situation where you're struggling, I would recommend talking to someone that you trust that is an expert in one of these areas before you just dive in, because it can be very expensive. Earlier we talked about being realistic and knowing your numbers. Well, that's very true before you get into anything like this. And not knowing your numbers can cost you dearly. I had a client one time that owed $200,000. We settled it for under $100,000. The creditor's own requirement was that he see financial statements. He goes, I want to see some evidence that they're really in the crisis that you're telling me. And we asked the client for financials. He couldn't provide them. I sent him to an accountant. The accountant turned him down. The second accountant turned him down. I called the accountant. Why won't you do financials with this guy? He said his records are so poor that I can't produce anything that I can put my name to, because every time you ask him a question, he either doesn't know the answer or he just makes up an answer. And then you figure out he's lying to you, so I can't do business with him. So I tried to explain to the vendor the situation, and he said, look, if this guy can't put a financial statement together, he doesn't deserve to run a business. And he sued him and put him out of business. I had another prospective client who decided to get a working capital loan from a phone solicitor that was selling merchant cash advance. And so I was trying to bring in American Finasco to settle his debt at a lower cost. Instead, again, he wanted to pay his debt off. I admire that. He said, well, I can get this loan. I said, you know, those things are usually expensive. No, this is only 13%. And so he did it. And then while later he calls me, he couldn't afford to pay this anymore. It was killing him. And I said, send me the documentation. Well, right there on the first page, it stated rate 13%. But when you looked in the fine print and calculated it, it was 13% every 4 months. So he was paying 39% annually, right? But he didn't know it because it stated rate 13%. You know, I know it's tempting when someone offers you money at a low hassle and, you know, we have it in your account tomorrow or 48 hours, but you risk, if you don't know the people, you risk getting in bed with some non-reputable, very unreputable companies that can cost you dearly. One such lender is called World Business Lenders. And if we have time, I'll tell you a story about them later, but avoid World Business Lenders at all costs. Live within your means. If you're alive this time next week, you'll be living beyond your means. So I had a client as a banker that was a successful contractor. He had started working out back of his truck. He was like the American success story. And he had built his business. He was so popular that he hired people. Eventually, we loaned him money to build a huge office warehouse and a showroom, and he was just living high on the hog. Well, then he started, you know, boats, jet skis, second house, season tickets to all the professional sporting events. And when he was working out his truck, you know, he was just spending all the cash that he had every week, just trying to survive. But now that he had a lot of cash, he was still spending all the cash that he had every week. So he had all the toys. When I left banking and I lost track of them, and then several years ago, I needed some work done on my house. I looked him up and called him to ask him, you know, to come out to my house and give me a quote. And I said, do you have a show, you know, still the same place to come by and see you? He said, oh, no, I lost all that. And he began to tell me the long story about how when the downturn hit, he started missing payments and the bank saw how highly leveraged he was. They just shut him down. And now he's back working out of his truck like he was when I met him, you know, 20 years ago. Contrast that to when I bought American Finasco, as I told you, I had to get a large SBA loan to buy it. The business was doing very well at the time. In 2011, we had our best year ever, and I took my staff on a trip to thank them and get paid bonuses, and everything was doing great. I did not change what I paid myself. I didn't like having that much debt, and so I just kept applying all the profits I had to paying down the debt. And then in a few years, I paid it down enough and had a track record after about three or four years that I could refinance on a conventional loan at a lower rate. Well, then some government regulations came in and changed that business entirely. In fact, today, we do about 1/3 in annual revenues of what we did in 2011. And so I'm very thankful that I paid down the debt when I had the cash. Had I taken the, approach my contractor did, I would have been in the same boat, because there's no way I could service that level of debt with the revenue that we have today. And it was all because of government regulation changes that I could not have foreseen that caused an increase in competition. I went from about 3 competitors to 300 competitors over the course of a year. And so, since we're the same time, Thomas, I'll make a Bible reference. If you know the story of Joseph in the Bible, You know, he was a prisoner who interpreted a dream for Pharaoh. Said we're going to have 7 years of prosperity and 7 years of hardship, so we need to store up in prosperity. And he ended up being number 2 to Pharaoh because of his wisdom and put in charge of, running Egypt, basically, and saved a lot of people because during good times, he saved and stored up so that during the lean times, they could survive. And that's what I'm recommending we do. So, a couple more stories and we'll be done. I want to tell you about the wrong way to do things and give you a couple examples of clients that did not treat me the way that I treat banks. At an RV park, it was an elderly couple that needed to refinance and cash out for this RV park. They had a lot of equity in it. Unfortunately, shortly after we did the deal, the father who ran the thing died, and so his son took over. Well, the son was nothing like the father. He immediately started treating me with disrespect. He wouldn't return my phone calls. He stopped making payments with no explanation. Checks were bouncing, and I had no idea what was going on because he wouldn't return the phone call. He wouldn't even talk to me about it. Well, this happened to be in a state, not Texas. It is a judicial foreclosure state, which means you have to sue somebody. You can't just give a notice of foreclose. And it got bogged down, so it was taking months, and I'm paying attorney's fees. And then a few months later, still without any communication with the borrower, his attorney called me and said, we've sold the RV park. I need a payoff letter, to know how much you need to get it closed. That's great. That was a dream come true for me. And so one thing you need to understand, loan documents are written entirely in favor of the lender, okay? Especially a hard money lender. So you've probably heard of the golden rule. He who has the gold makes the rules. That is how hard money lending works. So you don't ever want to get into a fight with a bank because you're going to lose. That's another reason, as I said, to develop good relationships with your bankers. In the crisis, you're going to be relying on your lender to show you some leeway and some mercy. And if they don't want to do that, they're probably not going to do that. The last thing you want to do is anger your lender to the point that they want to punish you. Well, that's what he done to me. So, first of all, if you remember the restaurant owner I told you about earlier, I'll use him again. He was a great guy. He communicated greatly, did everything we asked him to do. And, because of the payroll tax, he wouldn't pay the sales taxes, the penalties. When he sold those buildings, he had to pay everybody off. And he needed about $300,000 to start his new business. And he was going to be about $30,000 short. And so he called me and explained that to me. And because he'd been such a good client and my investors had made good money on this transaction, negotiated discount, everything, we lowered our payout by $30,000 so that he would have the money he needed to start a restaurant. So that's an example of what happens when you have a good relationship and you do what you're supposed to do. So back to the campground. So, when you stop making payments, all kind of penalties kick in: late fees, default interest, forbearance fees, collection fees, etc. So I started adding it up. I felt sorry for his mother who, had lost her husband, and so I decided I was going to give him a break. And so instead of adding up all the fees, I just charged a flat fee. It looked something like this. So it was $1.5 million the principal, all that interest that he hadn't paid for a long time, late fees, and then I just put a PIA fee on there of $25,000 plus the attorney's fees, and that's what he owed. So I sent that out, and his attorney immediately called me and said, "Hey, I don't understand this. What's a PIA fee?" I said, "Well, your client is a pain in the ass, and so I'm charging $25,000 for being a pain in the ass." He didn't think it was funny. So he went berserk and started screaming at me and telling me all the things that were going to happen if I didn't take that off. I said, "You're right, I'm sorry, I'll take it off." So I took it off, and I sent him a new payoff. You may notice that the payoff balance went up by $24,000. So I went through and I documented for him. I told him what page of the loan agreement he could find the default interest rate, and the late fees and the 2.5% renewal fee that wasn't charged or paid. And so now, thank you for pointing out my error. I've removed the PIA fee. Please pay $1,635,000. Well, he called me back with a slightly different tone. He was very apologetic and said, I guess I should have read the documents before I went on money. I said, yes, you should. And he said, well, anyway, we can go back to the PIA fee. We will have to pay the PIA fee. I said, no. That fee is increased. And I said, I'll tell you what, your client has refused to call me back for over a year. You haven't called me and apologized and explained to me why he didn't return my phone calls. So he did, and I ended up basically giving them about $10,000 or $15,000 off that, but it was still more than they would have had to pay originally, and a lot more than they would have had to pay if he just been cooperating. I've had 2 cases where we were going to foreclose on somebody, but the people were good. I said, look, if you'll just sign this over as a deed in lieu of foreclosure, so I don't have to go through the foreclosure process, I'll release you from personal guarantee. And that means you don't have any judgment, any foreclosure on your credit record, and I just own the property now, and it's like nothing never happened. And 2 people have done that and worked out great. I've got another guy that we need to foreclose, and the only time he talked to me, he lied to me, and then he refused to talk to me. And he was in a judicial foreclosure state, so it took us a year to foreclose on that property. And, oh, I'm sorry, I'm over time. So let me wrap this up real quick. Bottom line is, I would have made the same deal to him, but since he wouldn't talk to me, he now owes me $400,000. He's got, collection agencies after him, and he's kind of living in hiding because he wouldn't talk to me. A lot of what I'm talking about here can be summed up in just doing the right thing because it's the right thing to do, right? Treating people the way you want to be treated, the real golden rule. So, in summary, I don't know why I got messed up there. Understand the numbers, be realistic. It's the only way you can be realistic is you understand the numbers. Focus on total cost, not monthly payment. If it costs you a little more per month to lower the interest and your overall costs, then do it. Apply for lines of credit when you don't need a loan. Character relationships matter, so treat your banker well and live within your means. Let money work for you instead of you working for your money. That's all I've got. Thanks for your time.